Hello everyone, welcome back to the channel. It's been some time since I've released a YouTube lecture, so enjoy this one. For the newcomers, welcome in. This is going to be a very interesting video for you guys. I'm going to be running over the 9 a.m. Sierra model, which is the model that I've created based around some liquidity concepts from ICT and the so-called CRT. All right, so let's dive into this. For the older students, this is going to be a refreshment on the 9 a.m. Sierra model. All right, so let's pull up we could do this on NQ, we could do it on ES, we could do it on anything. But I think we'll tap onto gold for this example here. Let's quickly hop onto that 1 hour time frame, which we are on, and we'll look for, I guess, the nearest 9 a.m. candle, which is right over here. So, all right, cool. I mean, this setup works out perfectly. We got it right over here. There's a couple main steps for this entire model. It's very straightforward, very simple. Don't worry, you guys are going to understand it. It's mainly about implementing it the right way. That's how you guys are going to generate your own success with it, right? Sometimes people like to use different entry models. Sometimes we can't all be at the charts at the same times, and so on and so forth, right? So step number one, we're actually going to type this out. We'll do it right over here. Step one being waiting for, sorry about that, waiting for the right time. Okay, when is the right time of day to be looking for trades? After 9 a.m. All right, so waiting for that 9 o'clock hour. Most importantly, why are we waiting for that 9 o'clock hour? Well, step number two becomes drawing out the high and low. High and low we're going to mark out by H plus L. So drawing the high and low of the 8 a.m. hourly candle. All right, so we'll draw that out right now. That is step number two. Turning on that magnet, drawing the high of the 8 a.m. candle. So we'll just write 8 a.m. high, and we will do the same for those 8 a.m. lows right over here. All right. Step number three. So step three would be find your key level, KL standing for key level. So this is going to come from the 4 hour time frame and so on. So 4 hour, 9 hour, daily, weekly, monthly, so on and so forth. Anything higher than that 4 hour time frame or at that 4 hour time frame. Do we have any key levels? Well, let's hop onto that 4 hour time frame and see if we do have any. What can be used as key levels? Let's actually run through this. Some of you guys may want to learn about this, or just need a little bit of a refreshment, right? So key levels, very simple, guys. Highs and lows coming from what? The daily and weekly. All right, so daily highs and lows, weekly highs and lows are key levels. We've got swing highs and swing lows also being used as key levels. Sorry about all of these spelling mistakes. So daily highs and lows, weekly highs and lows, swing highs and swing lows. We also got every single PD array. And that is literally it. So what is a PD array? We got fair value gaps, we got breaker blocks, we got order blocks, we got mitigation blocks, rejection blocks, etc., right? FVGs, what are FVGs? SIBIs and BISIs. So buy-side inefficiencies, buy-side imbalances, sell-side inefficiencies, or sell-side imbalances and sell-side buy-side inefficiencies. All right, so BISIs and SIBIs. So we're just going to write ETC, and that is what the key levels are. All right, so do we have any here? We're on the 4 hour time frame. 8 a.m. high and low, which is within that 6 a.m. candle, keeping in mind everything after this candle and from this candle was not formed yet. So it's anything prior. Do we have anything? We actually have a 4-hour gap that we are reacting off of. And we will mark this out. So this is a 4-hour gap right over here. We'll mark it out. 4-hour key level. And we also got a pretty decent 4-hour swing high here. So this is also a 4-hour key level. I want to mention why this is a swing high. Give me 1 second here. So why is this a swing high? Why did it not use this high? Why not this high here? We use this high because there's a lower high on the left, lower high on the right, confirms a swing high. So before this candle closed, this was not a swing high. After this candle closes, this becomes a swing high because the high to the left is lower and the high to the right is lower as well, forming that swing high on the 4-hour time frame, which is the key level. Okay, now we can incorporate the daily bias, we can incorporate the weekly bias, which is what you guys should be doing every single day. And I'll just pull up that daily time frame really quickly here. We are above, so we are in an expansion state, right? And we can see that pretty clearly. This is Friday's candle expanding up and to the right, and we got Thursday's candle right over here. The high of this range would be right there, and then we got the targets being right over there. So we'll hop back down to the 4-hour, and what do you notice? Price at the time that we're looking at it is already above these highs right over here, and we actually displaced. So we're still bullish. Why would we be bullish? Well, we got these highs above us that need to be hit as well. Interesting. We're moving from internal range to external range liquidity. Where's the external range liquidity? Above this high right over here. So what can happen is maybe running from internal range to external range, back to internal range, and back to external range, back above the new high created, and hitting final liquidity, which, as we know, is that high that I pointed out from the daily time frame. So now we can hop down to the 15-minute time frame. This is where we're actually going to find step number 4. And this is basically where the lower time frame confirmations come in, and where you really got to start focusing. This is where your focus is going to do you good, if I should say. Okay, so just dial in, okay? What do you notice? ADM highs, ADM lows. Just drag this out just a little bit here. All right. So, step number 4. Step 4, we're looking for a lower time frame CRT within the hourly CRT. So what's the hourly CRT? It's this ADM candlestick range. We're looking for a lower time frame CRT within the hourly. What is the lower time frame CRT that we're looking for? A 15-minute. And we're looking for the purge of that 15-minute CRT to tap into a key level as well, while either being above or below those ADM levels. All right, so what happens here? Let's just take out our drawing tools. Do we have any? Yes, we do. So you notice right over here, as we tap that 4-hour key level, we actually have the 15-minute high and the 15-minute low of the previous candles. We're just going to mark this out and drop down to the lower time frame, but you can see it very clearly over here. 15-minute high, 15-minute low. This is the 9:15 candle, and 9:30 manipulates us above the swing high, so the 4-hour key level, above the ADM range, above the 15-minute CRT, and we can look for the entry model from that point on, targeting those ADM lows. And really, that's the thesis here. Your idea would have been a complete retracement to those ADM lows to then finally head towards external range liquidity one more time. Longs here could have likely been gathered up as well. This happening at 12 o'clock lunchtime, so a completely different model, so to say. It's not the 9 a.m. CR, but there was a play there to take while understanding internal range to external range liquidity and having your bias in mind as well. All right, so now we're going to move down to the entry model. And I want to keep this as basic as possible, okay? Really just a raw video, unedited video. I'm not going to put any time into editing this video. I want to show you guys everything live as it would be done on a live stream, just pre-recorded, right? So what's the entry model, man? It's very, very, very simple. Order block, IFVG, normal FVG, or even a breaker. So a lot of people, they get confused when they start hearing people talk about entry models. Here's my entry model. Here's my entry model. Guys, an entry model is just that PD array or the low or the high that you use to enter your trade. Very straightforward, very simple. Don't complicate it. Order block, IFVG, fair value gap, breaker. This comes after all of this. I did not write it. I'm going to add it just to make it clear. So bias and draws on liquidity. This is number 1. This is number 2. This is number 3. And finally, number 4 would be the entry. Okay? For your entry, where are we going to go? The 1 minute to 5 minute time frames. Okay? So we'll hop down to the 1 minute and we'll look at what happened here. Let's just move this over so we can keep it in frame. There you go. Let's do it like this. All right. So what do we notice here? As price is taking out that 15-minute CRT high, we tap into the 4-hour key level. I'm just adjusting everything here to make it look pretty for you guys. Doesn't really matter, but whatever, it is what it is. So take out those 8 a.m. highs. The time is now 9:34. We manipulate those highs. 9:30 pushes us down into this order block right over here. And you'll see that order block being pushed into. We push up into these highs right over there, 9:37. We end up expanding lower. Where is the order block that formed here? I'm going to give you guys all possible entries. Every single possible entry that you could have gotten on this move. Even if you missed the first order block, you could have still gotten it. We have an order block right over here. The most dangerous and risky play, but the most rewarding and explosive. Order block formed as soon as this 939 candle closed right below that low. Tapping into it is your entry, or as soon as we close below it, validating it. That's your entry to go short. This is what your short looks like. Entry short, stop loss at the short-term swing high, and you are targeting those 8 a.m. lows, which is right over here. That would have been a beautiful 12.84 R to R trade here on gold. You would have been out of your position at 1136. So beautiful position there, 12.84 R to R, and I'm showing you guys here live. I had no idea gold even had a setup on this day, but live in action, man, just looking at your charts, pulling up some old results, clearly it works, right? So that's the 1 minute time frame using the order block right there. Was there any other potential entry? Something that sticks out to me a lot is this fair value gap right over here. And we're going to inverse this as it was inversed. As soon as this candle right here, 941 candle closed below this gap, that now becomes an inverse fair value gap. You could be entering shorts either as soon as the candle closes or as soon as we tap into the inverse fair value gap. You would be entering short at that fair value gap, either having your stop loss at the swing high or the high that created the inverse fair value gap. At this point, it's better just to have it at the swing high, relatively close, doesn't really matter. And then TPs at those lows, this would give you a 4.24 R to R. So you notice how the R to R drastically drops, but you still get a valid entry, IFVG. Why is this a valid IFVG? Because this low was not yet tapped into. What do I mean by that? I'll draw this out really quickly. This is probably going to save you guys some. If price came and inversed this fair value gap, and this candle right over here, 941 candle, closed while wicking below this low. So let's say we closed right here, but we wicked below this low. This IFVG becomes lower probability. Why? We already swept internal range liquidity. The point is, you want price to tap into the inverse fair value gap, run beneath these lows. You're now secure. If price reverses back up, well, maybe you should be stopping back out at break even, because we should be breaking structure and not reversing it, taking out another high to then come down, which is just, sometimes it'll happen, so you can destroy types of days, 1 minute liquidity runs, but majority of the time, this is what tends to happen right over here. Okay, so that's the inverse fair value gap entry. Is there anything else that we can look at? There's no 1 minute fair value gaps here. There is a beautiful breaker, now that I'm looking at this very clearly. So what's the breaker here? It's this candle's low. Do we close below it? Yes, we do with this 946 candle. I'll just mark this out. Bearish breaker right over here. It's the order blocks. So let me just simplify this. A breaker is the order block that was supposed to be used to continue pushing prices to the upside, but got broken. And that's why it's called a breaker. It broke. Okay? What does that mean? Price is doing what? Moving up. Every single time it's breaking a high, breaking a high, breaking a high, right? Till eventually at one point, when price expands, comes down, respects the order block. Price comes up, comes down, respects this order block, right? Price comes up, comes down. This is the order block. We break it. We close below that order block right over here. Now becomes the breaker. We tap into the breaker. Breakers can lead to explosive price movements, and you can have very, very tight stop losses on breakers. Okay, let's just get rid of all this drawing to keep it clean. What you can do with your breaker block entry, first off, you can have your stop loss right at the high of the breaker and TPs at the lows. That would give you a 6.2 R trade, so an even higher R to R compared to that IFVG. You can also have your stop loss at the midpoint of that breaker, which I wouldn't recommend. And then ultimately the most conservative, or not conservative, the most liberating stop, I guess you should say, is at the swing high, which is still valid. You got a 2.42 R to R, still valid trade, and that's the breaker. Now, after that breaker block, is there any other time that you could be entering this to quote unquote chase price action? There are continuation trades that you can be using to enter off of. So what is that? Well, we're on the 1 minute time frame here. You have any type of internal range low, or sorry, not internal range lows, but intermediate term lows. Let's remove the breaker. Let's remove the order block. Let's delete the 15-minute CRT right over there. Do we have an intermediate term low? We got a short-term low right over here. No other short-term lows. We got one right over here. Short-term low, and no short-term lows right here other than this one, which is lower than this, so that's not the shift. We got a low and a low. This would be that shift. So this break and structure right over here, 15-minute CRT low being broken, we'll actually remove that now. Turn on the magnet and draw this out like so. This is the market structure shift. So study intermediate term highs and lows, and you'll understand market structure. As soon as we wick below this low, not close, rather wick below the low, we respect that first fair value gap. So let's take out the tool very quickly, draw this out. We have the midpoint of this gap that is being respected fully, never closing above it, literally almost to the tick there with this 950 candle. In the macro, we're inside of the inefficiency. Where are we going? We're probably going to chase equal lows. Is there any equal lows right in front of us? Very simple, guys. Macros are going to push us towards liquidity. What is the highest, not highest, but the best form of liquidity that acts the most magnetic? Equal highs, equal lows. Find them on the 1 minute here. If we're in a macro, we took out this low, that doesn't count. Right over here, we took out that low, doesn't count. Is there any equal lows that we could be looking at over here? To me, it looks like there isn't really any equal lows. There is some liquidity. So we've got liquidity right here. We've got liquidity right over here as well. We got more liquidity below us. I just want to pop up the 5 minute time frame and see if it makes sense. On the 5 minute, liquidity would be resting below here, 5 minute fair value gap below here as well, below that order block, and then of course beneath these lows as well. So it would come in and make sense there. Let's go back onto the 1 minute, see if it works out. 950 to 1010. We got 950 right over here inside of the fair value gap. We should push prices towards these lows for the macro. What happens? 950. It is now 10 a.m. We already hit this liquidity. And by 10:10, we should have hit. So 10:10 right over here. Still not hit that liquidity level down here. We end up reaching for that at 10:12, so 2 minutes later. Still valid though. Okay, so that is the beauty of macros. If you know where liquidity lies, you can always still get in late after the fact. And that's expanding on the 9 a.m. CR model. All right, so very quick, straightforward 21-minute video here. I hope you guys enjoyed it. Raw footage of me going on the charts and showing you guys the models that I like to execute every single day. The next video I release is going to be explaining the London Twilight model once again. And yeah, that's going to be it, really. If you want more in-depth analysis like this or more in-depth lectures, or if you just want to see me live trade, feel free to try out that 7-day free trial for the TSR Premium group. Link is in the description. You can even find the link in my YouTube bio as well, and my bio across all my social media accounts. Now, for the ones who stayed till the very, very end, literally the last 30 seconds of this video, I want to explain something. If you don't have a 4-hour key level for the 9 a.m. CR model in specific, at 9:30 to 10 o'clock in specific, if you don't have the 4-hour key level and you have a 1-hour PD array or a 1-hour range of liquidity, that could be a high or low or a PD array, or a 15-minute for that matter, the power of 3 is in front of you and it is perfect accumulation, manipulation, distribution at the key time. You have clear draws on liquidity and a clear bias. The 4-hour daily or weekly key level is not needed. Rate this as your B+ setup and execute it with less risk. Trust me, your performance will improve greatly. Now this, I only implemented into my own strategy at the start of 2025 after really visualizing my results of 2024. You know, there's always ways to improve, and this was my way of getting to that next step. Both of which are still profitable. If you only want to use the key levels, feel more than free to do so. I did that all of 2024. That being said, I found it was more profitable if you can execute without that 4-hour key level, but everything else that I mentioned is in alignment, and that's the most important part here. Okay, so those of you who stayed till the end, that question was probably running through your head. I answered it. I used to be against rating setups A+, B+, as you should only be executing A+ setups. But in the case of my yearly review, I had to come to, I had to humble myself and go back up a little bit and tell myself, listen, I think the better play for you to do is have that B+, go, you know, you don't need to have an ego for this especially, right? We're all just improving as we go. So that's the gist of it. I'll catch you all next time, and peace out.